What's up, everybody? Thank you for tuning in to another episode of the CPA Zone, the podcast where we discuss tax strategies and accounting tips for entrepreneurs and real estate investors. My name is Ryan Pulis, and our company, the Pulis Group, offers tax planning and advisory services for entrepreneurs like you. Whether it's bookkeeping, tax planning, or CFO services that you're looking for, we've got you covered. What's up, everybody? Ryan Pulis here with another episode of the CPA Zone. Today, we're going to talk about the grouping election available to real estate professionals. So this election is found in the regulations under section 1.469-9G. So often you're going to hear this referred to as the 9G election. That's simply a reference to that regulation citation. So as a reminder, and as most of you probably know, qualifying as a real estate professional opens the door to deducting your rental real estate losses against active income like business income and W-2 income, as long as you materially participate in those rentals. Now, to qualify as a real estate professional, you must pass two tests. As a recap, those tests are: 1, more than 50% of your time must be spent materially participating in real property trades or businesses. And 2, more than 750 hours must be spent materially participating in real property trades or businesses. If you clear both of these hurdles, then your rental income is no longer in the default passive bucket. So remember, passive activities are those business activities in which a taxpayer does not materially participate, or a rental activity, whether or not you materially participate. So by definition, under the passive activity loss rules, under section 469, rental activities are considered passive regardless whether you materially participate. They're just by default passive. So that's what we mean when we say they're in this default passive bucket. Now, as with many things in the IRS code, there's exceptions to this. One, and the most common, is qualifying as a real estate professional. So qualifying as a real estate professional gets you out of that default passive bucket. The default treatment for rental activities is no longer considered passive. It just gets you out of that passive bucket. Doesn't mean you can deduct your losses yet. So once you get out of that default passive bucket, you still need to show material participation. Now your rental activities are treated just like another trade or business, where your material participation determines whether the losses are going to be considered passive or not. So qualifying real estate professional out of the passive bucket, now you show material participation if you want to deduct your losses. Material participation in an activity requires involvement in the activity's operations on a regular, continuous, and substantial basis. So because trying to qualify something as regular, continuous, and substantial is a bit difficult, the regulations give us 7 tests to demonstrate material participation to the IRS. When it comes to real estate, the most common test, we'll talk about the most common, which there's 3 of them. 1, participate more than 500 hours during the year. 2, you do substantially all the work, meaning you don't hire anyone to do anything else. You're running it as a one-man show. Or 2, you participate for 100 hours during the year and not less than any other individual. So others can be involved in managing or running the property. Their time just cannot exceed yours. You're doing the most and you have over 100 hours to get this 3rd test. So if you qualify as a real estate professional and you materially participate in your rental activities, then you can deduct those losses against your other active income. Now, as we mentioned, default treatment is that each rental property is a separate activity, or actually we probably didn't mention that yet on this episode, but in the past, every rental property you have is its own activity for purposes of material participation, meaning you need to show you materially participate in each rental activity on its own. This can be really difficult or even impossible if you have a large number of properties. This is where the 9G election comes in and really helps. This election allows a real estate professional to group their rentals into a single activity. Now, before you can make this election, you have to qualify first as a real estate professional by passing both those tests. More than 50% of your time spent in real property trades or businesses, and more than 750 hours spent in real property trades or businesses. Only after you pass that test and you're considered a real estate professional can you make this 9G election. So it allows you to group all of your rentals into a single activity, and this is really going to come in handy for passing the material participation test. Now, if you have, so let's just say for an example, let's say you have 10 different properties. Without the election, you're going to have to show you worked 500 hours in each property, or substantially everything was done by you in each of the 10 properties, or 100 hours and more than anyone else in each property for 10 properties. That gets to be a whole lot of work. Where if you group them together, that now in your 10 properties, you only need to show you spent 500 hours in total, for example, on all 10. And so that's what the election allows you to do. Now you have material participation. You can deduct those losses on the properties. To make the election, you have to attach a statement to your return that indicates you're grouping the rentals into a single activity under the code that's provided for real estate professionals. So the statement needs to contain a declaration that you're a qualified taxpayer, meaning you're a real estate professional, and you're making the election pursuant to section 469C7A, which is the Internal Revenue Code section governing this election. Simply combining or aggregating the income and expenses together on Schedule E is not going to cut it. That's been thrown out by the courts several times in the past. There's multiple cases where this has been the case. Once the election's made and in place, it's good for the current year and all future years. So even if in the future you don't qualify as a real estate professional, maybe just one year you don't hit the hours, your election to keep the grouping in place remains. You're allowed to revoke it or change it if your circumstances change in some material fashion that warrants it, but you have to get permission from the IRS to do that. So once you make the election, it's in place for the current year and going forward, and your rental activities are all grouped together and considered one. An example of a case where this backfired on a taxpayer is we have Sheik versus Commissioner. This is Tax Court Memo 2010-126. In this court case, the taxpayer failed to group the rentals into a single activity, which prevented them from passing the material participation test for their rentals. And then their losses were not deductible. So the taxpayer in this case qualified as real estate pro, passed those tests, but did not get the crucial material participation test simply because they didn't make the grouping election. If they grouped their activities together, their time for material participation would have been more than sufficient, and they could have deducted their losses, but they didn't attach the election to their return. This is a case where they tried to go the route of saying, because we grouped or consolidated all of our income and losses together on Schedule E, that should qualify as making the election. The courts denied it, as they have in past cases, and the taxpayers weren't allowed to deduct their losses. So that just goes to show how important it is to have a professional working with you to make sure little things like this aren't missed. And just getting that election in place in the first year is very important. So you want to make sure you're working with a professional and someone's there kind of checking, looking over your shoulder, making sure everything's right, all the T's are crossed, I's are dotted. Because without it, the courts and the IRS, they're going to throw it out. They're not going to allow it. They have a list. They have certain rules that need to be followed, and failure to do so can really cost you big in terms of tax dollars. So that about does it for today. I hope you found value in this episode. If so, please leave us a 5-star review and hit that like and subscribe button. Until next time, have a great day. So that about does it for this episode of the CPA Zone. Thanks for listening, and I hope you found something valuable that you can take away. We are taking on new clients, and if you'd like to work with us, then go to our website and fill out the client intake form on our contact page. This can be found at thepulisgroup.com/contact. That's ThePulicegroup.com/contact.